Most people are familiar with the two ETFs that track the Straits Times Index. But did you know that there are actually a few more funds that let you track the Singapore market, with some even outperforming the STI ETFs by a wide margin? In this video, we will be going through all of the most popular funds that track the Singapore market. Which one should you go for, as well as which are the best brokers that you can use to invest in these funds. As a bonus, I've compiled all this info into this super detailed spreadsheet, which you can download for free, link down below, yeah? First up, let's look at the three funds that track the Straits Times Index, more formally known as the FTSE Straits Times Index, though some people like to call it the Singapore Terrible Index, despite its recent strong rally. The three funds are Spider STI ETF, ticker symbol ES3, Nikko AM STI ETF, ticker symbol G3B, and the Amundi Singapore Straits Times Fund, which was listed very recently on Endowus. All three of them hold the top 30 companies listed on the SGX. Together, the three banks alone make up for almost half of the index, which means the STI is very heavy into financial companies. This is followed by about 16% in industrials and another 16% in real estate, of which roughly 10% are in REITs. Many of the holdings in the STI are mature dividend-paying companies, with close to 70% of them offering dividend yields above 4%. As a result, the STI tends to have relatively high dividend yields, which currently is above 4%. For ES3 and G3B, the dividends are paid out semi-annually, while the Amundi Singapore Straits Times Fund accumulates and reinvests the dividends instead. So out of these three funds, which is the best fund you should go for? For most people, the default choice would be the one with the lowest cost, and in this case, that would be the Nikko AM STI ETF. G3B has the lowest expense ratio of 0.26% as compared to ES3's 0.28% expense ratio. However, it is important to note that their expense ratios aren't fixed, as they can fluctuate slightly from year to year depending on fund management costs. For example, in 2023, the expense ratio for ES3 was actually 0.26%, which was slightly lower than G3B's 0.28% for that year. Meanwhile, even though Amundi Singapore Straits Times Fund has a rather low fund level fee of 0.15%, if you invest via Endowus, you will also incur a 0.3% platform fee, which will bring the total to 0.45%. Because of that, either ES3 or G3B would be a good choice for most investors. Both of them have a high trading volume, pay out a similar dividend yield, offer similar annualized returns, and are eligible to invest via CPFOA and SRS. So, in what case would the Amundi Singapore Straits Times be a good choice? As of right now, I guess the answer would be convenience. That's because this fund reinvests the dividends instead of paying them out, and being a unit trust, it doesn't have any bid-ask spread. Though, if you do invest in the Amundi Singapore Straits Times, just be aware that the difference in fees will greatly affect your returns over time. For example, if I invest 100k into each of the three STI funds over 20 years, assuming a 6% average return, with ES3 and G3B, my investment would grow to $305,000, while the Amundi via Endowus investment will only grow to about $295,000. That's a $10,000 difference just from the fees alone. Though, of course, if one day the Amundi Singapore Straits Times is listed on either POEMS or FSMOne, which charges a 0% platform fee, then the story would be very different. Quick pause. If you are looking for the best brokers to kickstart your investing journey, check out Interactive Brokers. You will enjoy one of the lowest fees in the industry, at just 35 cents per trade on the US stock market. It also offers Ireland domiciled ETFs, perfect for saving on dividend withholding taxes. Plus, it also comes with free company research tools, so you can make smarter investing decisions. Feel free to use my Interactive Brokers link to open an account and start investing today. Alright, let's get back to the video. Next up, we have the iShares MSCI Singapore ETF, ticker symbol EWS. This ETF is listed on the New York Stock Exchange and tracks the MSCI Singapore 25/50 index, which includes large and mid-cap Singapore stocks. What sets this index apart is the 25/50 diversification rule. Under this rule, no single stock can make up more than 25% of the index, and the combined weight of the 5 largest holdings cannot exceed 50% of the portfolio. I'm looking at you, DBS, OCBC and UOB. But here's where it gets interesting. If we compare the historical performance, EWS has outperformed the STI ETFs over the 1 year, 3 year, and 5 year analyzed periods. The reason for that is the difference in index methodology. So in 2020, MSCI updated its rules to allow foreign listings to be included in its index. Because of this change, EWS now includes companies such as Sea Limited and Grab Holdings, both of which are headquartered in Singapore but are listed overseas. Property Guru is also one such name, though it has not been added to the index yet. That being said, EWS comes with a few drawbacks that makes it not so ideal, especially if you are a Singapore-based investor. First, EWS charges a much higher 0.5% expense ratio, which is almost double the cost of ES3 and G3B. Second, because EWS is US domiciled, Singaporeans will be pipped with a 30% withholding tax on dividends. This is a big problem, given that many of the Singapore stocks are high-yield dividend payers. Not just that, there will also be up to 40% estate tax, which could take away a huge chunk of your investments when you pass away. Oh, sorry, they are no longer your investments, they are your descendants' investments now. Third, EWS is priced in US dollar, which means there will be currency fluctuation risk. So if you are investing in the Singapore markets for income stability, this may be a rather big issue. And lastly, you can't invest in this ETF via CPFOA and SRS, which kind of sucks. Though if you are a US investor, then this ETF would actually be rather appealing, as you won't be affected by the dividend withholding tax nor the USD-SGD currency fluctuation. Interestingly, this ETF was previously available on SGX but delisted in 2016. So one can only hope that they will come back again. Lastly, we have the X-Trackers MSCI Singapore UCITS ETF, ticker symbol O9A, listed on the SGX. O9A tracks the MSCI Singapore Investable Market Index, which provides the broadest exposure among all the Singapore-focused ETFs in this list. While the STI covers just the top 30 stocks, this index includes large, mid, and small cap companies across the Singapore market. This means you are not only getting the usual big names like DBS and Singtel, but also exposure to the smaller and emerging companies that could offer higher growth potential. Currently, this ETF has a total of 65 holdings. Similarly, given that this is an MSCI index, it includes Singapore headquartered companies that are listed overseas, such as Sea Limited and Grab Holdings. As such, this ETF was able to deliver higher performance than the STI ETFs. Besides that, one big benefit of this ETF is that it's listed in Luxembourg, so there's no dividend withholding tax and estate tax to worry about. However, it is denominated in the US dollar, so there's currency risk involved. Not just that, the expense ratio is at 0.5%, which is on the high end. But I guess this isn't so much of an issue, provided that it can give potential higher returns due to the additional holdings. Its average trading volume is rather low, which means its bid-ask spread will be a little wide as compared to the STI ETFs. Though, this again isn't that big of a deal unless you are trading it frequently. Again, unfortunately, you can't invest in this ETF via SRS or CPFOA. So those were the 5 funds that allow you to invest in the Singapore market. But which one should you go for? If taxes and currency fluctuation weren't a concern, I would actually go for O9A, as it is a lot more diversified and allows me to invest in large, mid, and small cap stocks in Singapore. However, given that the main appeal of the Singapore market is high dividend yield and low volatility, it might be better to go for either the ES3 or G3B, since they are denominated in SGD, pay out dividends, and don't have any taxes to worry about. Moving on, what are the best ways to invest in these ETFs? Many of the banks offer some sort of a regular savings plan to invest in them, such as the OCBC Blue Chip Investment Plan and the POSB Invest Saver. But due to their relatively high fees, it might be better to use low-cost brokers to invest instead. For this, most of the low-cost brokers such as Momo Singapore, Tiger Brokers, and Weibo only charge around $1 to $2 in fees. But there are actually a few brokers that allow you to invest for free. First, USmart offers 0% RSP when you set up regular savings plan to invest in the Singapore market. Same for FSMOne, which has a similar promo. Meanwhile, CMC Invest offers 5 free trades in the Singapore market every month. sign up to any of these brokers for some attractive welcome rewards. Otherwise, if you wish to invest in these ETFs via a CDP broker, the cheapest method would be to buy via FSMOne via the 0% RSP, then transfer the ETFs to your CDP for free. Though, this step may be a bit mafan for some people, and the transfer to CDP may take a few weeks to complete. So, if you don't want that, the second cheapest way would be to buy via DBS Cash Upfront mode, which have a 0.12% fee with a minimum commission of $10.90. For more details on the best ways to buy CDP Singapore stocks, check out this video here. Anyway, there was a quick comparison between some of the most popular funds that let you invest in the Singapore market, as well as the best ways to invest in them. Hope this helps you out. Like, share and subscribe as I'll be posting new videos every week.